The S&P has rallied, and we're at an important point, which will determine whether or not the market is going to go into a melt-up or not. Today is July 9th, and we have been saying that the market was going to run up into the 63.50 area, and it did. And we can see in our matrix diagram here that the yellow curve, which is now presently at 63.80 roughly, has stopped the market repeatedly. And so breaking through this yellow line and the red line right above it, which is another important matrix line, which is at roughly 6,400, will determine whether or not the market's really, really strong and continuing to be a blow-off type market, or if it's going to settle down and do something more like the 20-year cycle, which we'll show you in the picture also. Okay, so right at the moment, the market is in a situation where the 8-month cycle is still running up. We've been saying this, and it basically calls for a high in August and potentially a second high in September. And the 2-month and 4-month and 6-month and all these cycles are kind of lining up nicely, and it projected the rally that just happened very nicely. And we expected a 2 or 3 day decline this week, Monday, Tuesday, Wednesday, potentially today being a low, and the market starting up again, going up into the 15th of the month, and then potentially having a pullback onto the 24th of July and another high early August between around the 8th of August potentially, and a secondary high again around the 22nd of August. We've said these things before, I'm just laying them out so you remember them. The question is, how strong will the price action be? What's important to realize is that this rally in the S&P, which most people think of as, oh, it's just another day, another year, this is the strongest rebound out of a 15% correction that's ever happened. The market has run up more quickly, and the corrections, which normally would be much larger, none of them have been sufficiently normal. Okay, every one of them has been less than we anticipated, and most technicians have anticipated. So it's an abnormal market. The question is it the early stages of a explosive, is it the early stages of what they call a melt-up or a parabolic rise, which just keeps going, in line with potentially what David Hunter has been saying and others. If indeed it does break above the 6,400 level in the next few days, and it can stay above that level, in other words, maybe retest 6,300 and hold and then start to rally again, we have the next levels up, which would be around 6,700 and then 7,200 and ultimately 7,600. But we don't have, but the timing of those things is unclear. Okay, but the first thing we need to see is if it can break above the 63.50 area, stay above it, and start to move higher. That's a very bullish scenario, indicating the probabilities of a melt-up are in progress. Now, the cycles that we've been watching that align with a melt-up format, the best one is the 60-year cycle. It's been there forever. It's been repeating for years and years and years. And it's probably the number one horse that we should be thinking is going to happen. If it does happen, it's interesting how basically it goes generally gradually higher. It's not an explosion type thing, but it does go gradually higher, and it eventually goes up into late this year, and then it makes a high approximately 1,400 points from the 6,200 area if it repeats what's called a tub swing, the swing that it did so far in order to come back to the high. If it doubles it and comes back to an equal amount above the high, it would be about 7,600. So that's a candidate that could happen. The second possibility, which we've been following, is the 20-year cycle, which goes up into August, even September, comes down into October, and then goes up strongly after that. So we won't see the big move until the end of the year. But either way, we're bullish. The timing has been pristine on it, by the way, but the pullback we expected did not happen in the magnitude of it. The timing has been right, but the pullbacks have all been wimpy. Okay, indicating that this is an abnormal market. And it's been validated. I mean, statistically, this is the strongest rebound, the fastest rebound in the history of the stock market. So it's not a normal market. You can't expect normal things from it. And therefore, the possibility of a melt-up is not outrageous. We also have the long-term momentum balance technique, which has long time ago indicated that the potential market would eventually rally way higher. We haven't been talking about it because it was so outrageous at that time that we got the signals that it seemed unreasonable. But now it's starting to look quite reasonable, and the target lines for that thing is probably up around 7,600 toward the end of this year. All right. So there's a lot of things starting to pile up indicating the bullish scenario is the right scenario. We have never avoided the bullish scenario. We expected a decline from December until April or May. But after May, which we expected a retest, not a new low, we expected rally. We expected the S&P to go up. We've said this a number of times. So people who are thinking we're always bearish, it's not true. We've been bullish with the exception of a 3 or 4 month pullback, which we expected to happen. It did happen. Also, I wanted to point out some interesting things. We look at cycles, and some of the cycles are very large, and some of them don't happen very often. But it turns out there's a historic event that took place almost exactly 80 years ago, and that was the Trinity nuclear explosion. It was the first nuclear explosion that happened in the world, and it happened July 16th of 1945, which will be 80 years from 80 years ago in a few days. The 16th of July would be the anniversary date. And that was the beginning of the entree into the world, into the nuclear universe, you know. And it's important to recognize that that tendency toward nuclear weapons and such is heating up a little bit now. We saw what happened in Iran and bombing and all this kind of thing. Oh, and 80 years is important because the 20-year cycle, the 40-year cycle, 60 and 80-year cycle, they're all in line with each other, and they're all real. So if this is an extreme market, and it's starting to look like it is, extreme markets on the upside could easily be followed by extreme markets on the downside. And oftentimes markets go down quicker than they go up. So the key thing here is to make sure you have protection and stops and some way of hedging off risk in this market, because the risk is growing even if the prices go up. A surprise could happen at any time that could take the market down dramatically. I also want to announce our Market Forecast Mastery Masterclass, which will be starting on July 20th. It's a Sunday. And it's going to be an expanded version of what we've been doing. We've added a number of features, including giving the students a number of signals. We have mechanical signals that have been generated by very well-tested algorithms in the past, and along with whatever else they learn, they're also being given. Right now we have 5 such systems that are being given along with the forecasting knowledge. Okay? So it's a very powerful program. It's very rich. I also want to mention it's not for beginners. Okay? We recently had a large group come in, and many people were not that familiar with trading, and I found it was not comfortable for them. So we want to make sure that people who take this class, they're at least somewhat familiar with actually trading the markets. They have some concept of risk management. They have some concept of getting in and out of the market, because knowing the cycles is good, but you also need to know how to enter the market and exit the market without knowing the cycles. Okay, this is an important point.